Why have gold and silver not broken out yet? And can we expect the same kind of rally this summer as last summer? We're here to discuss this, price targets, and macroeconomic forecasts with Phil Streible, Chief Market Strategist at Blue Line Futures. Phil, welcome back. It's been a while. You look great. Thank you for coming.
Oh, thanks, Dave. Yeah, thanks for having me. So yeah, it has been a bit concerning since that sell-off we saw in the previous 2 weeks on gold and silver. They flashed down pretty hard. Now we're kind of trading sideways. We're trapped in a range on both at the moment, although I believe that both the ranges will be broken back out to the upside. Gold, that key level you want to look at, 1795.60. If we break above there, we're going to recapture 1800. I think that it'll grab a lot of headlines. People start coming in. You have the speculators moving in the market. We should rally on some accelerating volume. Downside support 1761. We don't want to really see that broken. If we do, we're going to be retesting some newer levels. And then on silver, 2650 on the upside, 2550 on the downside. But you look at some of the base metals; they're starting to recover, and I think that silver will break back out to the upside.
You know, Phil, it's been interesting because we've talked about this before. Gold has been at a crossroads, and there's been many forces tugging and pulling at the metal. Let's talk about the dollar first. Inverse correlation with the dollar, as we know. The dollar has been strong. Where do you see the dollar headed from here?
Yeah, I'm not too bullish on the dollar. I think that the dollar had really overestimated its move on the past 2 weeks. We've been short the dollar index. Many of the clients have short dollar index. We've ridden this train. All these different themes, they've been going on since about last June to last November. There were two kind of pivots there where we've been playing the same trading direction and method on the different markets. So, we believe that the dollar index will roll over. British pound got a bit oversold. You are seeing a bit of, buying into the dollar, buying into bonds and other safe haven assets because of the fact that this Delta variant is capturing some headlines. There are some renewed lockdown restrictions. We're seeing oil prices, they're selling off a bit today. So there is some concern out there, and that, I think that could be a new catalyst for, additional Fed stimulus, them backpedaling on some of their hawkish tone and their hawkish narratives. I think that gives that, that movement that gold needs in order to start pushing back higher.
You would think that the hawkish tone we've seen from the last meeting at the FOMC would bring the dollar higher. Is this long-term supporter for the dollar? You think that potentially we might see 2 rate hikes next year?
See, I don't think they could do it. I really don't. I think that what happened is that inflation blew away their expectations. They thought that the recovery in the labor market would happen first, and then the inflation would take off, and then they can, start doing interest rate hikes. They didn't realize that the supply chain issues and the lack of a recovery in the jobs market caused these supply chain breakdown, to cause all these inflation variables to shoot through the roof. Now they're like scrambling. They're like, oh my God, we need to come out and say something really aggressive. We're going to do 2 interest rate hikes and this and that. The reality is that they still need the labor market to come back. They can't all of a sudden start raising rates aggressively if the labor market has recovered. And the labor market, I can tell you, is 12 to 14 months away to get into pre-pandemic levels.
Mm-hmm. And the other variable that affects gold, of course, is inflation expectations. Perfectly ties back into the Fed policies. Where do you think the Fed is going to take rates in relation to inflation? I mean, if inflation runs hotter than their 2% target for a consistent period of time, they're going to have to raise rates, right?
Yeah, but they ultimately they won't be able to do it. So they'll only be able to do it one time because they're having a breakdown because the labor market's not recovering. So, gold's perfect environment is when growth stalls, which that's what we're forecasting in the back half, and inflation goes up. That's that inflation narrative. We back tested gold all the way into the 70s, 80s, and all these different variables, and that is when it performs its best. And we're expecting to go into that. We've seen small periods of it, and we saw a massive stagflation period. That's when gold actually reached its peak. That was the bottom in a lot of commodities. Things started coming back. The vaccine rollout, things like that. The vaccine, the number of people that are getting vaccinated, that rate of change is slowing down dramatically. It feels like anybody who was going to get vaccinated or didn't, they kind of made their choices here. So, we'll see if the Delta variant actually has an impact on the growth of the economy. And with inflation running hot, jobs market stalling out on the recovery, I think gold could be really good. It's come to some good levels, and we built a strategy. I published it on Kitco a couple of times recently on how to play gold to the upside using the futures contracts.
Perfect. And of course, you can read more of Phil's work at kitco.com. But for now, Phil, can you give us a bit of a teaser on your strategy?
So what we did was for accounts that were like $20,000 on the futures side, we came in and we bought 2 of the 10-ounce gold contracts going to December at 1775. We're adding 2 more if we hit that double bottom, pull up the chart on gold, a daily chart, you'll see at 1685. We would add 2 more there. We're holding for the stagflation period to kick in and a seasonal tailwind rally at the end of the year where we believe we could target back again at that $2,000 level. So we're looking to ride this one out for the long haul and add some gold at these lower values while they're on sale. The smaller accounts, like guys that were like 5 to 10,000, what we did was a silver call spread. Remember, gold and silver, they're a similar set. They tend to move together. And what we're looking at is the upside on that. We bought the 29.31 call spread, and we're going all the way out to March. There's 260 days to expiration. It costs about 50 cents, which is $2,500. The max gain would be $1.50, which is $7,500. So pretty calculated risk. I know a lot of your viewers are all, they are stackers, they are physical holders and things like that. There's nothing wrong with it. We're just looking at an enhanced way to speculate on the market to try and bring better and stronger returns in a liquid market.
It's interesting you mentioned 2 strategies for different account holders. Does your strategy vary depending on the size? Is it because of varying risk tolerances depending on the account size?
Exactly. Some people like calculated risk play. A lot of people are silver believers. We think silver's got more upside than gold. They tend to, silver tends to make 2 times the move that gold does, or, it declines 2 times as much. We look at a downside on silver as very limited from here. Gold may face some additional selling pressures, and it hasn't had that buying that we've seen. We were just discussing India and how they had, 25 tons of gold. They have 25,000 tons of gold on hand. However, they've shifted dramatically into the cryptocurrencies.
Exactly. $200 million of crypto now. They're at $40 billion. They've climbed from $200 million in aggregate holdings to $40 billion in just 1 year. First of all, this trend is happening worldwide. It's not just India. And second, India is important because it's a very big market for physical gold. So what's the thesis here, Phil? Do you think that suppose if they shift back into gold, would that provide a boost?
That would be huge. I mean, I would want to monitor how India and how they're perceiving some of these cryptocurrencies, like how China's done crackdowns on cryptocurrencies. We've seen the price of Bitcoin get cut in half, many of the smaller cryptos cut in half. If India does take that kind of direction and they start shifting back into gold and silver, some of their more traditional holdings, you could see big boosts, especially in their central bank holdings, and that would push prices back higher.
Phil, do you think it might be a generational shift in India? Do you think the younger generation of India might not be as accustomed to buying gold and silver as their parents did? And if that's the case, then 20, 30 years down the line, when they have kids of their own, they might not be buying as much gold, physical jewelry, bars and coins as the previous generation, which would significantly dampen the jewelry demand in the country.
They tend to, so in all these market boom and busts, like back, you look at 2000 .com era, everyone was a day trader in technology stocks. That had blown up, and then they shifted back into more traditional assets. Traditional assets tend to perform over long periods of time. You have smaller periods where you can capture these dramatic gains, but I really think that, someone needs to have a diversified portfolio. You can't just hold one or the other. And still, I believe that you can get multiple times your money on a product like silver, rather than, Bitcoin is facing, additional headwinds. You've got Binance, you've got, excess speculation lockdowns. It's perceived attracted a lot of negative attention because of ransomware attacks. So, there's quite a few things that are out there that may be hindrances of Bitcoin's longevity and ability to rally.
But even suppose we have a shift back from crypto into gold. Well, India is known as a country to have one of the strongest demands for gold and silver jewelry in the world. So most of the physical market is comprised of the jewelry market. How big is the jewelry market overall compared to the rest of the gold market, Phil? Do you think it's significant enough to push gold prices up, even if everything rushes back into gold jewelry?
Sure, it could make a substantial impact on it, and you look at, I mean, it's not only just gold, but it's also, silver is that poor man's gold, and they tend to target that as well. And we could really see that we could see that have more of a true, where they're shifting out of cryptocurrencies going into silver's actual uses are continuing to grow. So if you get all of a sudden India selling cryptos going into gold, then realizing that gold prices are historically high, they may look at silver, which is historically low, and start adding some of these holdings. And that's where you can see prices start to trend higher. Like, I truly believe that you're going to see silver, where the floor is going to be $28 and will be averaging 32, 33, 34 into next year. And I believe that gold is going to continue to maintain these elevated levels. It's just they naturally price band higher as time goes on, and the corrections are getting shallower. They're violent, they fall quickly because of volatility spikes, but they're quickly swallowed back up. That's why we were putting on these long-term strategies at these lower levels here, and we want to ride it out to capture that next move higher.
I've noticed, of course, earlier in the year that when gold spiked up to its all-time highs, that it followed a similar pattern to 2011 when back then it spiked up to nearly $2,000 and it fell back down all the way to $1,500 and flatlined for a couple of years. And when we hit $1,700 earlier this year, Phil, I was getting a little worried that the same thing might happen. Yeah, we hit a resistance level, or support rather, and now we're bounced back up. Do you think it's possible that we might retrace $1,500 like we did back in 2012?
No, I don't think so at all, because of the fact that the dynamics have changed, where there's more. They're coming up with, the Federal Reserve and other central banks are coming up with more creative strategies to apply more money in the markets. I mean, it's like one of the first times in history that I know of that, the federal government literally just sent people checks, all over, and they didn't really verify what was going on. That money is going to be hard to, expunge back out of the market. I know they've got reverse repo windows. They're providing all this liquidity and lendings out there. But I just think that, they're not going to get the recovery. It's they want it too perfect. They want, we want inflation at this level, and we want, jobs at this level. Well, the jobs market is pretty broken. There's a lot of people that are not going back to work ever. There's a lot of pushback on it. You're seeing concessions being made for work at home and things like that. And I just feel like, that's going to have a longer lasting effect than what they anticipate. And as a result of it, they're not going to get the recovery that they need. So they're going to end up only being one interest rate hike, maybe doing some tapering, but the tapering won't be as aggressive as what they think. That's where people are concerned about the growth recovery in U.S. equities will most likely dive. And then we go into more of a, like I said, a stagflation period. That's where gold tends to perform its best.
Yeah, these macro forces that you talked about, monetary policy and of course, the stimulus checks that you mentioned, these should have been very supportive for the gold price over the last couple of months. Yet, of course, as you've seen, it's been flat. How would you summarize the gold action in the last, I would say, 4 to 6 months or so? Why do you think gold has not yet broken out when maybe it should have already?
Well, because of the rising yield environment. So you'll have, when yields are at zero and gold yields zero, you tend to have people that shift into gold, and they hold it because it has more of a chance of bounce back recovery. So they acted as a trading vehicle. Once they realized that yields were rising, people that are not interested in gold for any other reason except this safe haven, it's got some store of value there, they're selling that position off. They're chasing treasuries and treasury yields, going back into U.S. equities. So if you look at gold, it's down 6% year to date. Silver's down 1%. It totally reflects in the macro themes environment. And then once the macro theme changes, you'll see gold will retrace it, and it goes into a seasonal rally towards the end of the year anyways. So I believe that, again, I think that equities will top. We were putting on some bearish put spreads on U.S. equities. We pared back some of our positioning there. We pared back a lot of our Bitcoin holdings, and we are going longer term with some of these bounce back plays like, again, gold, silver. And another market that we've been all over, I've written on Kitco, was the oil market. Since November, that was a great recovery play. Now I think there might be some concerns that OPEC is going to increase production, and the Delta variant could play a role with increased lockdowns. You can see, kind of peak demand at the moment. So we are paring back some of our oil positions as well.
Okay, and finally, now you mentioned a seasonal rally towards the end of the year for gold. You're looking at $2,000, correct?
I really believe it could get going again. 2000 would definitely capture some headlines on the upside. I think that it has the right dynamics for it. You need the Fed to backpedal. You need growth to kind of stall economic growth. We're already seeing how susceptible the market is. I mean, when we were doing this video, they started capturing news on the Delta variant. All of a sudden, travel leisure stocks sell off. The Dow Jones sells off. Russell sells off. S&P is flat because of its tech holdings, and they go back into tech. So it's very like easy to see what they're doing and why they're doing it, what narrative they're gripping on. And I believe that narrative can play out into the end of the year, and that's where we can see gold futures continue to gather some steam. We need those big players like India to roll into some gold, though, and I think that would get it going.
So our viewers might be wondering, why end of the year, Phil? Why not the summertime like last year?
No, because the summer is okay. You got two different things. The 10-year hit its all-time low. It was like last August. It hit it to like 2 times. It was a double bottom on the 10-year, like 0.4%. We don't have that treasury dynamic in there. So what happened then is different from now. This is going to be, we're going to make it through. We're going to have great earnings out of equities. And then once you get past this earnings cycle, those earning comps are going to disappoint. Economic data is going to disappoint. That's where the slowdown in growth occurs. And then the Fed backpedals.
Yeah, and of course, last summer we had the unlimited quantitative easing that took everybody by surprise, and that definitely helped. We're not getting that this year, so slightly different dynamic, I guess. All right, well, thank you very much, Phil. Appreciate your insights as always. Excellent analysis. I look forward to getting your update again soon. Thank you.
Thanks, Dave. Thanks for having me.
And thank you for watching Kitco News. I'm David Lin.